We're closing in on the final day of the Joe Biden era, and as Donald Trump gets set to retake office, he brings along some regulatory uncertainty. For more, let's bring in Scott Clemons, BBH Partners and Chief Investment Strategist. So Scott, there's a lot of unknowns here. What are you looking at as Trump 2.0 takes off on Monday? We really have this regime change in Washington.
I think it's safe to say that we're entering a new phase of deregulation, the shape and the scope of which is uncertain, because what's also uncertain is how much he can accomplish by executive order, and the answer is quite a lot, and how much he's going to need to rely on Congress to pass. Of course, there's a Republican majority in Congress, but it is razor thin, which gives a disproportionate voice to a handful of people who have other ideas. We've seen that play out before in the GOP caucus. I think we're going to see it play out again. But a year from now, 3 months from now, 6 months from now, certainly a more regulatory-friendly environment across a lot of industries.
What about tariffs, Scott? The Journal is reporting today there was actually some friction in Trump world over that issue. There were some who were pounding the table, apparently, in that camp. Listen, let's go aggressive, let's go broad, let's go big. Others, they're saying, like Bessent, his pick to run Treasury, would prefer, why don't we get narrow, focused, targeted? How do you see all this playing out?
Some context for that is that tariffs have been a tool in a presidential toolkit going back to George Washington. His second act of office was an executive order levying tariffs on Great Britain to protect American trade. So it's a very common tool. He used it, Biden used it, everyone's used it. The scope with which he wants to use it, I think, is where the friction is coming from. If he steps in and proposes blanket tariffs as a matter of economic policy, I expect some members of Congress may raise a hand and say, Mr. President, I'm all on board with this, but I'd like for us to consider it as well. I think he'll end up getting his way. I mean, again, he has a majority in Congress, but we're moving into some untested territory with the use of tariffs as an economic incentive, as an economic carrot or stick.
I want to switch gears to the Fed. We did get some good news earlier this week, a slowdown in core prices, but many experts still saying that we're not out of the woods yet. So when you look out to the next year, how do you think the Fed balances the risk of potential bumpy inflation with also potential slowing growth depending on what policies Trump does choose to implement?
It's going to get harder. Right now, the Fed has the luxury of inflation coming down enough, albeit gradually, to allow them to think about lowering interest rates. And of course, they've acted on that already. But there's not enough economic stress yet to require them to lower interest rates. I think it's a fortuitous quirk of the calendar that after the Fed meets next week, at which they will make no change whatsoever, the next Fed meeting isn't until March 19th. So they've got 2 full months of more economic data, labor and inflation, most importantly, but they've also got 2 months of the new Trump administration to see to what degree these tariff proposals play out, immigration proposals play out. I think that March 19th meeting, which I've circled in red on my calendar, is probably the most important Fed meeting of the year. That's going to give us some indication as to how the Fed sees that balance of potential rising inflationary pressures, but also potential some economic storm clouds gathering.
Scott, we had another smart strategist on the show this week, been watching the markets a long time. He said, he did not think investors were paying enough attention to the possibility that actually the Fed does raise this year. That there is the risk of we see some just kind of another buildup in pressure of inflation, in part because of some of the fiscal policies that we've been talking about here. What's your take on that? Probabilities, as you see it, they actually would have to be forced to raise in 25.
There's no zero probabilities anywhere in finance. But right now, there's enough downward pressure, particularly in core inflation. And the 2 real engines of the sticky inflation and the core inflation numbers are, maybe surprisingly, auto insurance policies and shelter prices. And those 2 things have in common, they're very lagged and they're very slow to reset. Because if you've just gotten a new auto insurance policy, you don't get a new one next month. If you just signed a lease, you don't sign a new one next month. So there's enough downward pressure in that I think would prevent the Fed from needing to raise interest rates. There's always the possibility of some price shock out there. So what I'm looking for is if this administration gets very serious and aggressive, not only with immigration, but deportation, what I'm looking for is a potential upward rise in wage pressure. That is something that will get the Fed's attention because that's more endemic. Wage pressure tends to cause broad spread inflation. It's not just your coffee or your orange juice futures or something like that. Wages is what to watch most carefully.
And to that point, I was thinking about this too, because it feels like inflation is going to remain at least hot over the short to medium term, especially when you think about some of those policies that you were just laying out. Does that mean the Fed can only really cut if there's major swings in the job market. Does that make it more important, the labor side of the story?
I think it does, and I think over the next few months, we're going to get enough evidence of weakening labor market that the Fed will have the ability to cut interest rates in response to that. I don't want to overstate that. That's just the labor market getting back to kind of a pre-pandemic level. And there, the thing to watch is not necessarily the headline unemployment rate, but deeper within that monthly report, the reasons for unemployment. What we're seeing over the past few months is that people losing their jobs is on the uptick. People leaving their jobs is on the downtick. So people are holding on to the jobs that they have. Firings are picking up a little bit. Those are incipient signs of economic stress. I don't want to overstate that, but that's the kind of thing that'll get the Fed's attention as we head further into 2025.